Well, hello, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining today's webinar that's being brought to us by Economatica. Our topic today is valuing publicly traded stock using the discounted cash flow method. I'm very pleased to have with us Emery Ventura, who's going to be delivering today's presentation. Emery is based out of the New York office and is director at Economatica and currently serves as the head of product management. So with that, please everyone join me in welcoming Emery for today's event. And I'm going to go ahead and pass you the controls, Emery, so that you can share your desktop, and let's get underway here today. Thanks for joining us.
Thank you, Cynthia. Thank you so much. Hi, everyone. I want to welcome you and say thank you to all for joining us today. You should have in front of you the startup screen of Economatica. The screen that you see at the moment is the DCF module, one of the components on our platform. We will start with the company that was indicated, which is Microsoft, as you can see here on the top. I figure we would start off with a company that we're all familiar with, a very large cap company. And as you can see, on the left-hand side, we have a number of different components. These are the components that we will be working on as we build our DCF. What we have done here at Economatica is we've simplified the process of putting together a DCF model by creating this user-friendly interface that you see in front of us. There's the tool itself, which is what I'm going to be showing you today, how to navigate it and how to arrive at a target price ultimately. But also, and just as important, Economatica has all the data sets that are required. Every company listed in the US and all the company's financials, pricing, and corporate actions are built into the platform. So you don't have to worry about getting information from separate sources to put together a DCF model. Similarly, the data for the securities that are involved, like debt securities, treasuries, the risk-free rate, that's all available on the platform as well. So we're starting here from the top. I have selected on the top left, sales and EBITDA. We're going to start here. So notice that the system immediately presents you with the last 5 years of history. It obtains the average sales growth per year from 2014 through the most recent published quarter. Similarly, EBITDA margin, it presents you as well with those averages. At any given point, you'll notice these sector buttons on the top. This is a great tool. If you press sector, what it does is it's going to use the NICE classification system, bring all of the peers, and calculate the average for that sector. So here I've pressed EBITDA margin sector, and it has populated the sector averages for us. We'll do the same for sales growth. And notice that on the fly is pulling in the peers and doing the calculation. So here we have the sales growth for the sector. Now, the system presents you below this table with the options that you have available. We can come in here and type in sales, okay? So as you all know, with DCF, you've done your homework, you're familiar with the company, you've done some research, you have some expectations of what's going to happen over the next years. So if that's the case, you can come in here and type in sales or the sales growth that you expect these companies to have, or you can ask the system to use the historical data that we have to project, to calculate the average over the past few years and project that forward. So let's say, for example, we're going to type in the sales growth. We'll come in here and type in 10, say 10, then 7, and finally, I'll say 3% thereafter. Notice that as I typed in these growth rates, the system immediately populates the cells on the right-hand side using the values that I've just entered on the left-hand side. Okay? I could have just as well selected the average over the past 3 years of the company, the average sales growth. Let's see what happens here. Notice how now it just calculated our average over the last 3 years, and it populated the sales numbers using now the historic average of the company. Okay. Again, we can return to the numbers that we entered earlier by simply making the selection down here. Okay. Now that we've done sales growth, let's move over to EBITDA margin. That's the next component that we need to project. As you would expect, as we enter EBITDA margin, we should expect this on the right-hand side, our EBITDA numbers, to be populated all the way down. So we're going to enter, again, we can enter our own figures or use the software to calculate the averages. Notice that the sector is much lower than the company. So what I'll do is I'm going to ask the system to use the historical over the last 3 years of the company. I'm going to take these values here and average them out. Okay? So we obtained 35.7 EBITDA margin, and immediately, as we expected, the EBITDA numbers have been populated. The period that we're working with is 10 years. You can see here on the left-hand side, perpetuity is set to 10 years. This is an option that you can change. We'll leave it as 10, but know that you can change that period, projection period. As you go down this interface, you'll notice these red diamonds on the left-hand side start to disappear as we complete the steps necessary in each of these. So sales and EBITDA now, that red diamond has disappeared. So we're done with this particular section. Now we can move down to the next level, which is CapEx and depreciation. Again, as I indicated earlier, what we've done here is we've made it a step-by-step guide to take you through the process of building a DCF. So we're just going through the steps necessary. So now that we're here in CapEx and depreciation, again, the options are virtually the same options we just discussed. You have to decide each step of the way. Do you want to enter the numbers? You've done your homework, you have the numbers, you want to put them in, or do you want to use the historic averages, take advantage of the data that's already on the platform, and let the system perform the calculation and project forward? So again, I'm just going to press the sector button to populate the sector numbers and inspect what they look like. So in this window, we're looking for CapEx and depreciation. To make it easier, we've created these ratios to derive CapEx and depreciation. So here's the depreciation to fixed assets. This is what the company ratios look like, and this is what the sector looks like. Let's do the same for CapEx to depreciation now. Okay, and this is the sector numbers. Okay, so what I'll do, let's select for the depreciation to fixed assets. Let's select the average again for the company, because as you can see, the company values are significantly higher than the sector. And for CapEx to depreciation, these numbers are very high. I'm going to select to enter my own number. And we'll enter into this box. $125, 125%. Double click and I'll populate this all the way down. Again, now that we've defined these two ratios, notice that depreciation, CapEx have been populated. And of course, fixed assets. Okay, we have the evolution of those numbers for the next 10 years. Then we come, notice again, the red diamond has gone away, which means we can go down to the next step. The next step is arriving at investments in working capital. To do that, we have provided inventories, receivables, and payables expressed in days. Okay? And using these three variables, we're going to arrive at investments in working capital. Okay? This is the formula that's going to be used to calculate investments in working capital. Okay. Now, again, we can look at the sector. That system goes out, calculates the sector averages for us. Okay, so this is inventories. Okay. Receivables. And payables. Okay. Keep in mind the system is making the calculation live. That's why it takes a few seconds to perform the calculation. So here are all my numbers, and once again, I can see immediately that Microsoft is on a class of its own, and the numbers look quite different. So I will ask for the system to project using the historical average of Microsoft over the last 3 years. As I make the selection for inventories, payables, and receivables, now we have on the right-hand side inventory investments in working capital calculated. So we get to here on the right-hand side. Again, the red diamond disappears, and we can step down one level. The next level is free cash flow. So now that we have performed these projections of sales and EBITDA, CapEx and depreciation, investments in working capital, the system now can calculate free cash flow for the firm using these assumptions we've submitted. So this is how the system makes the calculation. Right? You can go through the entire math and arrive to free cash flow. And this is just a table that can show you each component that has been used. As you can see, it's color coded, so I can match it to each component and visualize the evolution of free cash flow. Now, while I'm in this screen, if you notice at the bottom here, we have how to grow cash flow in perpetuity, and we have the income tax rate. Both of these you can adjust, okay, from the default. The cash flow is growing at 0% in perpetuity. I'm going to click that and say that I want this growth to be, enter 1.5, for example. Okay, so this is how we're going to grow cash flow in perpetuity. Hit OK. Now that 1.5 shows here at the bottom. Okay. Next, we have the debt capital of the company. And here's the capital structure of Microsoft. So this is basically debt over debt plus equity. Right? D over D plus E, where E is, we define it as the market value of equity or the market capitalization of Microsoft. Okay, and what I'll do is, again, as you know, just for the sake of keeping things simple, once again we will ask the system to perform the calculation using the company average. Let's take a look at the sector. Okay. And here the system is performing the calculation. See what that looks like. Okay, so this would be the capital structure for the sector, the average of the peers, and this is that of the company. Cost of debt on the right-hand side. The platform allows you to perform projections in real values or in nominal values. We've been performing all of our assumptions in real terms. As you can see here on the left-hand side, we're projecting real values. Okay? That's why you see these two options. Let's enter here. This is basically the cost of debt for Microsoft. I'm going to put in a 0. Okay, and that brings us down to the beta. Again, we have the levered beta on the left-hand side, we have the correlation, and we have the capital structure of Microsoft as we have just submitted our assumptions. Here's the unlevered beta, okay? And you've noticed as we've been going through the platform, these question marks, if anytime you need to look up the formula, how are we calculating something, it's not a black box. You can always take a look at the formula being used to arrive at that calculation. Okay, so this is the formula for unlevered beta. Now, what I'll do, again, similar options. How do we want to project unlevered beta? Do we want to use the average? Do we want to type our own value or the average of the company or the sector? So I will select that we want to use the average of the company over the last 36 months. Okay. At that point, we arrive at a target price. You notice here on the left-hand side, we have the current price of Microsoft. That is yesterday's close, 107.6. And the moment that we submitted our assumption for the beta, the system is able to generate a target price. We're going to go through now in the next screen how that calculation was performed. So again, we've put in all of the elements necessary to arrive at that target price, which was ultimately our objective today. Let's take a look at the next screen here on the left-hand side, which is the WACC, the weighted average cost of capital, or the discount rate. Click on WACC, okay, and here it is. So using this screen, we can see that the system arrived at a 6.6 discount rate or weighted average cost of capital. Okay, again, this would be the formula, the standard formula for your WACC calculation. Okay, it's cost of debt times D over D plus E plus the cost of equity times E over D plus E. Okay, as I mentioned earlier, all the data, all the components that form part of the DCF process are part of our database. So the risk-free is one of those factors that go in, and we have all the values. Again, you don't have to, as a user or an investor, worry about compiling all this information from other sources. It's already part of the system. And that's a great advantage of the platform. So the cost of equity, again, all the formulas are part of the system. So this is how cost of equity is calculated, as we all know, right? Okay. Now, let's come one level down and take a look at target price, okay? So this is the calculation of the target price. The target price we arrived at is 83. We're creating a hypothetical case, of course, here. We're putting in rough assumptions, right, for the sake of this exercise. But given the assumptions we put in, we have a downside of 22%. We work our way down from the present value of cash flow to that share price, target share price. Okay? And this is how it's calculated. You can see here we're adding these things together, right? Here's the debt, the cash, work all the way down to the target price. Once we have this target price, we populate several key ratios, okay? Price to earnings, price to book, where you can compare the two. I can also, if you notice here under this legend, there's a button for sector. So if we push the sector button, as you can expect, it's going out and calculating the average ratios for the sector as well. So let's see what these look like and how they compare to what we have in front of us now. Okay, and these are the sector ratios, okay, and side by side. Okay, so let's go down here on the left-hand side to the last option that we see, which is the sensitivity. And this is key because sensitivity, as you'll note, let's press the button, and it's making the necessary calculations. It's going to create this spider chart. And what's great about this is that this can help us see what are the components that are most influential on the target price. Therefore, what we need to be really careful, and we want to make sure we get right. So this blue line here, for instance, is the EBITDA margin. So we can see how the middle point is what we projected. These are the values we projected. And the step is how we're deviating by 20% each step of the way and finding the impact on the target price. So if we deviate 20% down from our projection, the target price comes down this way. If we deviate 20% up from our projection, the target price goes up this way. And then we can analyze each of the individual components and see the impact on target price. Clearly, Microsoft, the black line here, which is our sales, very important, right? As well as this blue line, which is the EBITDA margin. Like simply looking at the slope of the line, we can see how important these components are. And finally, I would say capex to depreciation, this red line, can be very important as well. Okay. These steps you can change if you want to create other types of simulations. You can enter. So, for instance, let's say we just want this to go 10% of the way, right? You can see how the graph, as I type in 10, is adjusting. Okay, you get the idea. You can create as many simulations as you like and see exactly what's happening to the target price as you go along. You control every step of the process. So if we go up here to this main menu and select properties, okay, for the US, which is the market we're working with, these are the instruments that are being used, right? So this is the 10-year Treasury bond, the 10-year inflation-protected instrument as well. In our case, we're doing real projections, so we're using a real Treasury for 10 years. These are but you can certainly come in here and make changes if you need to, and enter your own values if they require changes. Okay. So you control every input that comes into this model. Okay. So basically, again, Economatica tracks every single company in the market. So this interface allows you to generate DCF models on an easy to use interface with all the data behind it supporting it. And with that, I think we're ready to turn this to the Q&A.
Okay, thanks so much, Emery. And at this point, I would also like to remind you that if you do have any questions or comments, notice that control panel over on the right-hand side of your screen. Simply double-click the questions title bar, and you can actually expand it and type your question in there. So I'm going to turn it back over to Emery now for Q&A. Thanks, Emery.
Thank you, Cynthia. Thank you. I see that we do have a question. Is your data GAAP? Yes. And that's a very good question. Thank you for asking. Economatica pulls all of the data from the 10K and 10Q filings. So this is the official data that gets reported through the SEC, as you all know, and in US GAAP, obviously. So the answer is yes. All the data is coming from one single source, 10Ks and 10Qs, and so it's as close to the source as it can get. Very reliable and US GAAP, correct. Another question that we have is, can we get this into Excel? Again, another good question, and thank you for asking. The platform does allow you to export this into Excel. In fact, you may have noticed when I brought down this menu before that you have these export options, and you can see there are several different formats that you can export this in. Once it's in Excel, you can of course make alterations there, make any changes that you need to. It brings out every calculation with the formula built in. So again, that's another way for you to see how Economatica is making the calculations that are necessary to generate the DCF. Another question is, how long does it take to update 10Ks and 10Q data? Yeah, we have a very sophisticated process that we've built over the years. I'm happy to say that our 10Ks and 10Qs are available shortly after they're made available on the same day on the SEC site. So as long as the official 10K, 10Q document is submitted, is filed to the SEC, is processed the same day, normally within a couple of hours. So it's very, very quick. Oh, the risk-free rate. No, we're using another question, and I'll repeat it. I noticed you used a risk-free rate of 1%. Is that based on a 2-year Treasury bond on inflation rate? It's because we were doing real projections. We're using RCMT, real constant maturity rates, of 10 years. That's what we use. But as a reminder, you're in control when you're generating this DCF, so you can use whatever rate you want to use. But excellent question. Another question that I have here is if you can select your sector, and the answer, when we're looking at the model, you notice we're each step of the way inspecting the sector numbers, the sector averages, and yes, the answer is that you can define the sector. And if you notice on the left-hand side here of the screen, sector definition, this is where you would go. And by default, we use the NAICS Level 2. This is North American Industry Classification System Level 2, but you can change this into another level of NAICS, our own Economatica sector, or you can also create your own peers. You can also create your own grouping and use that instead. So you select what the peers should look like if you think that's a better way. Many of our users do like to choose peers rather than using an industry classification. Good questions all around. Anyone else?
Okay. Last chance to have any of your questions answered. Go ahead and put those into the questions panel. And also at this point, I'd like to remind you that we have been recording today's presentation, and each of you will get a direct link to today's recorded playback soon after the session ends. So if you do want to come back and review those concepts that Emery has been talking about, simply watch your email later on today. Now, Emery, I did mention that I'd be happy to show folks where you can access Economatica on the Interactive Broker platform. So what I'm going to do is grab the controls back from you for just a couple of moments here. Let me get back into, okay. I'll go ahead. Yeah, there I have it. So I'm going to grab the controls back. And I do want to bring up, notice here that I've got the trader workstation is sitting in the background, and wanted to show you that Economatica, it has been integrated into IB's platform. You'll find that you can access the information underneath the new window button. Down at the very bottom of your screen, you'll find analyst research, and here is where you'll be able to access the Economatica platform. So notice you can go directly from within Trader Workstation. Now, I do also want to bring up, we do have some additional information on our website. If you go underneath the pricing menu, you'll find research news and market data. And here is where you can find the pricing for Economatica. Also want to mention that we do provide a 30-day free trial subscription. So if you'd like to try it, you can access that information and even request that trial period directly from the Interactive Broker website. So with that, I'm not seeing any additional questions come in. Have you seen those, Emery?
No, Cynthia, I think we're good.
Okay, well, that then will conclude our session. Thanks so much, Emery, for your presentation here today, and all of you for sharing some of your day with us. Now, you can exit today's event using the X in the upper right-hand corner of your screen. Thanks, everyone. Have a great rest of your day, and make sure you watch your email for a direct link to today's recorded playback. We've also will be including the webinar notes there as well. So with that, thanks everyone. Have a great rest of your day.
Thank you all. Thank you.